In the last month, I've spoken with a lot of people considering a move to Alberta, and a lot of people that already live in Calgary, and I keep having the same conversation. The way the news is presenting the real estate market is creating some pretty unrealistic expectations for people, whether they're thinking about buying, selling, or just trying to stay informed. And I get why. The national headlines aren't great right now, but what the stats are actually showing and what I'm seeing on the ground tells a different story. So let's get into this, because if you're making any kind of real estate decisions in Calgary right now, you need the real picture, not the headline version. And the real picture, if you know where to look, actually has some really compelling opportunities in it. So where is all this doom and gloom coming from? It's not made up. There are real things happening at the national level that are making people nervous, and I think it's worth walking through them so you understand the backdrop. The Bank of Canada has been at the center of a lot of anxiety lately. Back in late March, bond markets were pricing in 4 rate hikes this year. Then, within a matter of weeks, that dropped all the way down to 1 expected hike for the rest of 2026. That's a massive swing in a very short period of time. And it happened because the bank made clear they're not raising rates to deal with an energy price shock. The conflict in the Middle East has been rattling oil markets and supply chains, but hiking rates doesn't fix that. So the bank is holding for now. But here's something worth knowing, because the media is going to run with this in the next couple of months. Inflation is about to look scary on paper. The March headline CPI came in at 2.4%, which looked fine, but behind that number, the raw materials price index, which tracks input costs before they hit store shelves, spiked 12% in a single month, the biggest jump since May 2020. The 3-month annualized reading on that is 120%. The industrial product price index, which tracks finished goods leaving factories, is up 25% annualized over the last 3 months. What that means is the next couple of CPI prints are going to come in hot, probably above 3%. The media will run scary headlines. I'm telling you now, so you're not surprised. The Bank of Canada's own April monetary policy report projects CPI peaking right around that level, and they're already showing short-term inflation expectations on the rise. And here's where I want to say something that I think a lot of people need to hear, because it directly affects anyone with a mortgage or anyone looking to buy. The Bank of Canada right now is in an impossible position, and I'm not sure they're being straight enough with Canadians about it. On one side, they have oil-driven inflation threatening to push prices well above their 2% target. On the other, they have a soft economy, rising unemployment, record insolvencies, and a housing market that is already under stress. Their own report acknowledges the output gap is sitting between negative 1.5% and negative 0.5%. That means we have an underperforming economy. You don't normally hike rates into that, but they also can't cut freely with inflation building. They're kind of stuck. Here's what I think is the most important practical thing for anyone watching this who has a mortgage or is thinking about getting one. The bank holding the policy rate does not mean your mortgage rate is holding. Fixed mortgage rates are priced off bond yields, not the Bank of Canada policy rate directly. And Canadian bond yields have already been rising since January, driven by war-related inflation risk. Lenders have been moving their fixed rates higher. The bank's own monetary policy report models a scenario where if oil stays elevated at $100 a barrel, they would need back-to-back rate hikes to bring inflation back under control. So think about that. Record insolvencies, consumer confidence at multi-year lows, and the central bank is publishing documents that include scenarios where they need to raise rates. Canadians had no part in a conflict in the Middle East, but they're being asked to potentially absorb the economic consequences of it through their mortgage payments. That's the part that, kind of gets me. Now, the bank's base case is not hikes. Their base case is that things stabilize, but the risk is sitting there in black and white in their own report. Now, moving on. The April labor force survey dropped, and nationally, the jobs picture is soft. Canada has lost a net 112,000 jobs in the first 4 months of 2026. Full-time work is down, part-time is up, national unemployment has climbed to 6.9%. But here's what makes Calgary different from that national story, and I'll do a full breakdown of the jobs numbers this week, so watch out for that video. Calgary employment is up 6.1% year over year. Our unemployment rate is actually down year over year. Labor force participation here is rising. Calgary's job market is in a different place than most of the country right now, and that is a significant reason why our housing market looks different too. At the national level, home sales in Q1 2026 were the weakest start to any year since 2009. Alberta was one of the weakest provinces, though, through that stretch. So the weakness is real, and we're not immune to it, but our employment foundation is giving us more cushion than most, and that cushion matters when we start talking about where opportunities are. One more thing before we get into the numbers. There's been a growing conversation about whether Canada is actually going to capitalize on its energy opportunity. The CEO of Cenovus used his earnings call to make the point that Canadian energy policy is making the sector globally uncompetitive. No major new greenfield oil sands projects have been approved since 2013. Capital is leaving for other jurisdictions. Alberta's energy sector is the foundation of Calgary's economy. If that investment continues to stall, it is a long-term headwind for housing demand here. Worth knowing if you're making a long-term decision about this market. Now, I know Danielle Smith is giving us all hope that we're closer to a deal for a pipeline, but I don't trust Carney, so I'll believe it when I see it. Okay, now let's look at what the data actually says. Total residential sales in Calgary came in at 2,104 in April, down about 6% from April last year. Year to date, though, through April, we're at 6,740 sales, down nearly 11% from the same period in 2025. Now, is that a market in free fall? No. And here's why. When you break those sales numbers down by property type, you get two very different stories sitting inside that one headline number. Detached homes had 1,095 sales in April, down less than 1% year over year, essentially flat. The detached market is not struggling. Semi-detached sales were actually up 14% year over year. Row homes were up 2%. Apartments are the outlier. 432 sales in April, down 27% year over year. Year to date, apartment sales are down 27% compared to this time in 2025. Consistent and significant. The condo market in Calgary has been pulling back all year. So when someone tells you Calgary sales are down, they're not wrong, but they're also not giving you the full picture. The detached market is holding up fairly well. It's the condo segment that's dragging the headline number lower. And as I'll show you in a minute, that gap between those two segments is where the opportunity conversation gets really interesting. New listings came in at 3,829 in April, down about 5% from last year. Year to date, we're at 12,789 new listings, down 7% from 2025. This is actually an important piece of context that most people miss. Supply is also pulling back. Sellers are not flooding the market. That's one of the reasons conditions haven't deteriorated as much as the sales decline alone might suggest. And it's part of why I think the overall market is more resilient than the headlines give it credit for. Total active inventory sits at 5,973 homes right now, up about 2% year over year. On the surface, that sounds like supply is building, but again, it depends entirely on what you're looking at. Detached inventory is actually down 2% year over year at 2,468 units. There are fewer detached homes available today than there were a year ago. If you own a detached home in Calgary right now, your equity position is holding up while homeowners in Toronto and Vancouver are watching their equity evaporate. Apartment inventory is up 3% year over year and sitting 27% above long-term average levels. And I want to point something out here. The Bank of Canada's own April monetary policy report specifically calls out a quote, substantial inventory overhang of small condominiums in some major centers as a reason residential investment will stay weak. The central bank is describing exactly what we're seeing in Calgary's condo market. When I say the condo market is under pressure, I'm not just giving you my opinion, I'm agreeing with the Bank of Canada. But here's the flip side of that, and this is important. That same oversupply that's pushing condo prices down is creating a window for buyers that simply has not existed in this city in recent years. If you're a first-time buyer who got completely priced out of Calgary in 2023 and 2024, you are looking at a segment that is down nearly 9% year over year with over 4 months of supply. That is a buyer's market. That is your moment if you're in a position to move and you want to buy an apartment. Overall months of supply for Calgary is 2.84, up about 8% year over year, just barely out of a seller's market within balanced market range, which is roughly 2.5 to 4 months. Detached is 2.25 months of supply. In the Northwest, West, and South districts, it's under 2 months. That is seller's market territory. And here's a number that I think will surprise a lot of people who have been told this market is struggling. In April, 26% of homes sold at list price or above. 1 in 4 sales. In a market the news is telling you is soft, that doesn't happen in a market that's falling apart. That happens in a market where motivated buyers are still competing for the right properties in the right areas. If you own a detached home in those areas right now, you have more power than the headlines are giving you credit for. Apartments are at 4.44 months of supply citywide, a buyer's market, okay? In the Northeast, it's over 7 months. In East Calgary, it's 12 months. At the current pace of sales, it would take a full year to clear the apartment inventory in that part of the city. If you're a condo buyer, you have real leverage right now. You can negotiate on price, on conditions, on possession date. That leverage is real and it doesn't last forever. Days on market is also creeping up. Citywide, we're averaging 35 days in April, up from 29 days a year ago. Homes are sitting longer. Now, realistically speaking, 35 days is still pretty quick if you're hitting that average on the selling side, but as a buyer, that extra time is useful and can make this process less stressful. The overall residential benchmark price for Calgary in April was $568,800, down 3.5% year over year. Detached benchmark is $745,400, down 2.7% year over year, but month over month, detached prices are actually ticking up. The picture varies a lot by area. West Calgary detached is up 1.4% year over year. Northwest is down just 1.3%. The steep declines are in the north, northeast, and east, which also carry the most inventory. Supply and price move together. That's not complicated, but it's worth saying clearly. And for anyone who owns a detached home in the better performing areas of the city, I want you to sit with that for a second. So while Canadians in other major cities are watching prices fall 10, 15, 20% from their peaks, Calgary detached prices in the west and northwest are essentially flat or staying positive year over year. That's a resilient asset in a tough national environment. Semi-detached benchmark is $690,200, down 0.3%, so essentially flat, holding up well. Row homes are at $422,900, down 7% year over year, a real correction in that segment, and again, a real opportunity if you're a buyer. And condos, the apartment benchmark in April was $301,400, down nearly 9% year over year. In some districts, it's worse. Northeast apartments are down 12.7% year over year. East Calgary apartments are down 11.7%. The Bank of Canada also noted in their report that falling house prices are weighing on household wealth and slowing consumer spending. When people feel less wealthy because their home is worth less, they spend less money. That's the wealth effect in action, and it feeds back into a softer economy. But here's the other side of that. Someone buying a Calgary condo today at $301,400 benchmark is buying at levels not seen in several years with wages higher than they were back then. The entry point right now on Calgary condos is genuinely compelling relative to where it was in 2023, 2024. So Let's bring this back to those conversations I keep having. When people tell me the Calgary market is struggling, what they're usually picturing is a citywide downturn. Prices falling everywhere, buyers walking away, sellers panicking. That's the national narrative, and it's bleeding into how people are thinking about Calgary. But that's not what the data says. Here's what I actually believe. Every market shift creates winners and losers. The question is whether you understand the market well enough to be on the right side of it. Again, if you own a detached home in a well-located part of the city, you're in a strong position. Your equity is holding up, your supply is tight, and you have options that homeowners in most other Canadian cities do not have right now. If you're a first-time buyer or someone who has been sitting on the sidelines waiting for the right moment, the condo and row segments are offering you entry points and negotiating leverage that haven't been available here in years. Is there risk? Yes. Is the macro environment uncertain? Absolutely. But real estate is a long game, and people who buy well during soft periods are almost always glad that they did. Now, to be clear, this is not me telling you to buy. You do you. And do not buy a home because someone said the market dropped slightly or that there could be opportunity. Only buy if it was already your plan, you can hold long term, and you can afford to. If you're thinking about moving to Alberta, Calgary's employment foundation is stronger than most of the country. People are coming here because the jobs are here, and the affordability relative to Vancouver and Toronto is still significant. That underlying demand is real, and it supports the market over time. Calgary is not in crisis. It is in transition, and transition creates opportunity for the people paying attention. If you have any questions, you can book a call with me in the link below. If you got any value from this video, please give it a like and subscribe if you want to see more from me. Thank you so much for watching. I really appreciate it, and I'll see you soon.